Welcome to the Simply Financial Podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's discussion. I want to start by talking a little bit about the Federal Reserve. They have not raised interest rates since July of 2023. So we are fast approaching the one-year mark since they ended their aggressive rate hiking cycle. They have forecasted that they are going to begin cutting rates. A big question is when and how much, but the forecast again is that rates will begin to come down. Let's focus though on the last interest rate hike, again in July of 2023. Looking at some great research, especially from JP Morgan, looking at the recent past, how the market does, say, 24 months after the last rate hike, provides us with a very bullish historical outlook. When the Fed stops cutting rates, it seems more often than not that the market does well over the next 24 months. In a lot of the podcasts, hopefully you've listened to them, I'll talk about how there's optimism around the cutting of interest rates. And what I'm talking about now, the evidence bears out that this optimism in the past has played out with good market returns by and large after interest rate hike cycle ends and they make their last hike. So if you go back, let me talk about the one exception. The one exception is that in 1999-2000 period, it was on the heels of rate hikes. The market did not do well over the next 24 months. Now, I'm a history geek. I don't know if you are, but there were some specific reasons, I think, that the trend did not continue. You had rate hikes. They stopped, but then you had the tech wreck, as it's called. This bubble that had built up in technology stocks came crashing down and the market struggled because of that. And then we had the life-changing event that 9/11/01 provided with the attacks on the World Trade Center and the Pentagon. And so that 24-month period after the rate hike cycle stopped, the markets were down. In fact, the markets were down in 2000, 2001, 2002, three very difficult years in a row. The next example I want to give was sort of mundane in the 2004-2006 period. Again, I'm thinking about 24 months after a rate hike cycle ends and you get to the last hike. The market was flat in that 2004 through 2006 period. Those are the two outliers. And again, that 99-2000 period, I think, is special in large part because of the uniqueness of the 9/11 attacks. But the other examples are strongly in favor of a bullish outlook. This includes 1998, 1989, 2015, 2016, 1983, 1984, and 1994, 1995. In those four examples that I gave you just now, the returns 24 months later range from around 27% over the 2 years, all the way up to over 60% over the 2 years. So I have expressed cautious optimism about this year and for the next few years, that the markets, driven by a good economy with the U.S. well positioned around the world, now that the bear market of 2022 is in the rearview mirror, now that we've moved farther from all of the interruptions and problems that COVID caused in the economy, that we could very well see a nice run in the markets. Of course, I cannot guarantee this. A lot can change. There's a lot of dangers, but this gives me a hopeful outlook about what the markets might be able to deliver over the next couple of years, now that it seems very, very likely that the last interest rate hike occurred in July of 2023. So I wanted to share that with you. This is an election year, so there's a lot of craziness that's going to be talked about this year, and the markets may very well have some volatility based on headline news, including geopolitical tumult and the presidential election. But as I think about the next year and a half to 2 years, this gives me confidence that history, using it as a guide, that this could be a good stretch for the markets, for investors. Here's to hoping that's how it plays out. I'll be back with you on the next episode of the Simply Financial podcast very soon. Please check out our website, the work we do here at Elliott Wealth Management. It's elliottwealth.com. Also, subscribe to the podcast if you haven't done so already. Again, I'll be back with you on the next episode of the Simply Financial podcast very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.